Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Welcome back and thanks for tuning in. Phil Tarrant is seeming like a distant memory. He's been away for so long. Stepping in to take his place just for the time being is Alex Whitlock. So great to be with you all again. I'm going to have a chat with a chap who I've bumped into around the traps elsewhere. His name's Mark Trowel. He actually heads up a property management business called Yabonza, but I want to talk to Mark specifically about his own journey in property investment. Mark is an investor, and although he's got a business that is in the business of property management, he's been investing for some time. Property is very much in his blood, and he's here today to talk to us. Mark, welcome on board.
Thank you for having me.
So the first question, why property for yourself? What was your first decision to go into property as an investment?
I've always had a love of property. I've always been able to see the true value behind property. It's always had a good growth trajectory over the years. And I think it's one of those asset classes that is actually real. It's got less of a shock to it as we see in various other asset classes. So to me, it's always been a tangible asset that actually you can see build value over time. Plus, if you look at population growth and various other factors around it, that only really just increases the value of property over time too. So I saw it as a good long-term investment.
So we just when we were catching up, just before we got in here, you were saying you bought your first property very early 2000. Just give us a bit of a snapshot as to where you were in that stage of your career. What was sort of going on in your life when you made that first purchase?
Actually, I was travelling around at the time. I was living in the UK and I came back to Australia to have a look at property. I understood, the market at the time, and it was just about felt that right time to get into it. 2002 market was doing okay, but you saw the sort of growth potential in that. It just obviously, hangover from the Olympics, things that were just going on. So I came back here and started looking at a number of properties and eventually bought up here in the North Shore, up in Roseville.
Okay.
So some of that criteria was, had to be a fairly easy distance to the city at the time. I wanted something close to transport. So it kind of ticked a number of boxes, very easy to maintain. So
if you're not familiar with the Sydney market, Roseville's probably, I'd say before the rush hour, you're talking probably 15, 20 minute drive into the city. So it's good and close, good proximity.
Yep.
What you decided you want to buy property, you'd obviously sort of had an idea of the kind of location. What was on your sort of checklist in terms of the type of asset you wanted to acquire for that first purchase?
I wanted something that would have a very good income stream. So The thing I was looking for mainly wasn't necessarily the capital growth. In that particular purchase was really just the income I was actually going to be earning off that property. So key to me in that investment was something that was going to have very low vacancy rates. And it was always going to be something that was going to be in high demand. I had a loan on that, so I wanted to make sure I could service the loan in the right way as well.
What was your price guide in terms of your maximum sort of purchase?
Things were a lot cheaper then.
They were. Everything was.
So it may sound small, but my initial purchase then was sort of in that 400 to sort of 500 range.
Okay, that's still quite a lot of money back then. I know the Roseville market reasonably well. I'm up in Turramurra, so it's not kind of a million miles away. So I'm going to guess then in that price range you were looking at a house and land as opposed to an apartment.
It was actually an apartment.
Oh, was it really?
Yeah,
My word, it must have been a nice apartment for 500,000.
It was new. It was actually a whole building that they just renovated, increased the size of the property, and had plenty of parking. So it had double lock-up garage, huge amounts of storage, big rooms. So they weren't just small bedrooms. They were 2 huge bedrooms, big kitchen, big living, balcony areas. So it was quite spacious. So it appealed to really a lot of professionals, or could have appealed to a family.
So for the property that you found, how did you go about actually tracking that down? Did you use a buyer's agent, or were you just going through, the usual online resources?
I'd been lucky enough to actually started my own property journey about 27 years ago, so really about that mid-90s. So I had a lot of experience in terms of how to track down the right sort of property, the criteria that I needed to buy, sort of the various areas that I wanted to buy in. So for me, it was just a case of really back then sort of jumping online, jumping into all of the papers.
It's worth this point saying, you've got a background in property management. You'd worked in that industry. You've also had a background in terms of property finance. So you know a little bit about how things work. So you'd use that to your advantage to go and to get a head start in terms of making this first purchase.
Absolutely. All of that sort of I was able to take on board and see what a good investment was.
So tell me what ticked all the boxes for this particular asset for you in terms of its yield, in terms of obviously, I know you say you weren't looking for substantial capital growth, but what was it that ticked the boxes in terms of its potential for good yield, in potentially low vacancy rates? How did you pick this location?
Exactly that, as you said. So I knew it was a certain distance to the city. at that sort of, it's sat within that commuter belt. So as you said, it's about roughly 15 minutes into town. It's good train line. So they really ticked a lot of boxes. The other thing, one of the criteria I looked at when looking for that property was low maintenance too.
Yeah.
Hence why
that can be a real headache. You know, you can really erode. That's the sort of the erosion of all cash flow.
Absolutely. And that particular time, that's why I went for an apartment over a house.
Yeah.
I didn't have to then worry about garden maintenance and all that sort of stuff. So it was a lower maintenance and lower upkeep to the property too. The property itself was one that had been built around that sort of 70s, 80s period. Okay. So it had a bit more room. But
how many were there in the, just tell me a little bit about the actual block that you invested into.
There was about 25 in the block.
Okay.
It wasn't just a single sort of tower block. There was a spread over about 4 different blocks itself. And it just recently, the whole entire block had actually recently bought by a developer who stripped them right back down to their bones and kind of rebuilt them up again. So it was a very stable property. It wasn't new, so there was no potential problems that may have occurred that you get.
Were there any? What was it like in terms of body corp?
Body corporate was just being set up at that time. So if you actually looked at the mix, it was probably about a 50-50 mix between investors and owner-occupiers. Okay. So it was a decent mix. It allowed then a lot of people to be quite active in the way that the property or the way the buildings were being run.
And what about in terms of contributions to sinking funds and so forth? Was there a lot of maintenance on the property, like, you know, kind of like lifts and swimming pools and tennis courts and all that kind of stuff?
No, there was... Luckily, it was quite a low rise, so there was only maximum 2 stories on each block. So it was all stairs. There was no lifts. There was no swimming pools. There was gardens, but they were kind of quite low maintenance gardens. A lot of trees versus lower shrubs and lots of stuff. So if you actually look at the property itself, there wasn't a lot that would need to be spent. The good thing there is also that because the whole entire blocks had just been redone.
Yeah,
there was no
worry
problems.
About.
Correct.
The reason I ask, the first property that I purchased when I started my investment journey, I bought off the plan in 1998 when I was based in Hong Kong. I bought a number of apartments in South Bank down in Melbourne. And look, the properties that I bought were particularly good in terms of capital growth. However, being very new to property investment, being quite naive, what I hadn't understood was the actual costs or the actual deduction from rent for all of the costs for maintenance of swimming pools, for maintenance of tennis courts, for the lifts and so forth. And they did get a good rental, but in terms of the net amount that I would see in my bank account every single month, it was a bit of a shock to the system to see how much was actually going on top of, you know, agents' fees and so forth. So look, I did do very well in those in terms of capital appreciation because it was very, very close to the Melbourne CBD. But from a cash flow perspective and as a first-time investor, where I was having to, you know, to maintain mortgage repayments, things were pretty tight. I wasn't getting the cash flow that I was expecting.
It's quite interesting you mentioned that, and that's one of the reasons I particularly went into this property. It didn't have a lot of capital growth, but what it did have was really strong income.
Yeah.
And that was important to me in terms of the loan I was servicing on that particular property as well, is that I really wanted to cover that. The good thing with that is that it was pretty much break even.
Okay, so that's really good.
From day one. So that was really good for me.
And just, you know, for locations in and around Sydney, even back then, getting a break even, you know, sort of a cash flow neutral property that's pretty impressive because you're looking at yields, you know, even going back then, really sort of 5% was really pretty good back then. So like a neutral, you know, cash flow means you're getting a pretty, you know, comparatively high rental for the value of the property.
Yeah, that's right. And that's one of the things I really wanted to make sure of because I was living overseas at the time. I didn't want to start sending a lot of money back, and it was then hard going to offset it against any income I was actually producing because I was living offshore.
How much cash did you put into it? You know, what was your LVR when you made that purchase?
For that, I was actually quite lucky on that one. I had saved up quite a bit of cash by that stage. So I'd really only borrowed around about the sort of 50%.
Okay.
55%.
Yeah, that's going to make life a lot easier. And living overseas, so then you've obviously got the challenge of how do you make sure it's tenanted? So what was your approach? And I know you'd got a background in property management. Did you engage a property manager or do you have a friend or family member who looks after it for you?
No, I'd actually engaged a property manager. I do believe in, even though I have my own business around this, I do believe in that engaging a professional is something that we need to do, especially when, you know, being distant from the property is, you know, how do things actually occur? So I did engage a property manager, although some of the problems I had were actually related to the firm I chose and I had to end up choosing a different one. But I did engage a firm to actually oversee that, rental collections and anything else that needed to be on, repairs and maintenance. Luckily, there wasn't a lot.
So with this first property, and I always like to get a bit of a an insight into people's mindset, because when I made my first purchase, I thought that was going to be my only purchase. And I remember when I bought my first unit, I was so excited, and I bought it off the plans. I had that awful 18-month period where I was waiting for it to be completed. But when I made the first purchase, I thought this will be my only property and I'll make other investments. I've since gone on to buy, in excess of 20 investment properties. What was your mindset as an investor?
Actually, first of all, to purchase the first in property, it does give you a sense of ownership on something. You feel like you've now got a tangible asset that you can actually track. So there was that sense of almost a little bit of euphoria sense.
Yeah, absolutely.
And then constantly tracking, how's it going? Am I collecting the rent? Am I doing this? Am I doing that? So there was a lot of interest, even though I'd managed a lot of properties previous to that. When you actually get in there yourself and understand, how that is producing income, you look at, you don't want vacancy rates and all that sort of stuff. It really then allowed me, I guess, to hone my skills in looking at an asset itself and then working out how you actually maximize that asset. So subsequent purchases to that has really made me look at things like location, things like overall returns, the state of the property. Does it require maintenance? Can it be renovated for further capital growth? So I've taken that, learned from the first one, and then applied it into subsequent properties post that.
You kind of realize when you make your first purchase that you're actually going into business. It's a bit of a weird thing, you're buying an investment property, you have, hopes and dreams and aspirations about capital growth and future sort of cash flow, but you realize that you are going into business because you have income coming in, you've got outgoings going out, you've got an actual sort of going concern, you've got people living in it, you start to employ people. And then when you start to make subsequent investments, that kind of business becomes bigger. And it's quite an interesting shift in paradigm. Yeah,
it's an interesting point, because even though it was my first property, what I realized is that you can't get tied up with emotion of the property.
Yeah.
So I think this is where you might have found a lot of those things where people buy a property and they say, well, this is my property, this is what, and they're straight almost treating it like their own property versus someone else's property that they're putting in there, or someone else's home that they're putting in there.
Well, I'd like to find out about the next purchase, and we'll get on to that just after this. So Mark, we were talking just then about your first purchase in Roseville, an apartment, $500,000, 50% down. Cash flow was the objective with that. So just talk us through now to the next purchase that you made, and just tell us whereabouts you were in terms of your investment strategy at that point.
At that stage, I was actually still living overseas, and I was looking at the growth. At that stage, it was 2006.
Okay.
So I looked at property prices, and there was considerable value or increase in value at that particular time. So that next one was really around sort of capital growth.
Yeah, okay.
So it was a property that I purchased that I thought, there was a lot of potential for it to grow quickly in terms of its value. Subsequently, it has.
What kind of asset were you looking at this stage? Did you have a specific target? And I know that you know your stuff in terms of having been in the industry, but did you go, I want to get this particular kind of asset, or were you open to a range of different opportunities?
I again probably just narrowed it down. The research is always good behind these things.
Yeah.
So I think we're saying, was I open to a lot of opportunities? I'm always open to opportunities and where it comes back. But I really narrowed it down into, okay, if I want capital growth, a particular area I buy in, it had to be strong population growth in those areas, had to have attraction of a lot of people. It couldn't be reliant, that particular area I bought in couldn't be relied on one particular industry or industry type. So I know that into the future, if, a particular industry pulls out of an area, there was still...
Got depth in terms of the economics that are driving that asset.
Absolutely. And all of those things are really important, because I think that's how you maintain that capital growth over time.
So how did you, obviously you're in the UK, you're overseas, where did you narrow down to the areas that you wanted to invest into?
For that particular property, it was something that was going to be around a capital city.
Okay.
So capital cities have less of those shocks. So it had to be something that I was able to basically say, right, it's got to be, again, almost the same thing. It had to be in a commuter belt.
Yep.
Had to be an area of strong population growth. Had to be an area that could be underpinned or allow itself to be any shocks to the economy, allow itself to have still a good stream of tenants come through.
Yeah, so you want, and also, you make the point about good population growth. So that's a buffer against, kind of the threat of either vacancy rates or, an oversupply where you start losing your return on your investment. So what did you buy and where was it?
Okay, for that one, I was actually living overseas, so I bought in the UK for that.
Oh, okay.
Property. So that one was in London. It was in West London. So at the time, there was a lot of growth going on in London, which is pretty good. Subsequent to that, it's grown about 120%.
Wow.
So it's been a great return on that particular property there.
So was it a new building, an old building?
120 years old.
Okay.
So it certainly wasn't new. It required a bit of renovation. So it had to literally be stripped and gutted out. So there's probably about, purchase price came in around about the £400,000, and then it was about £75,000 spent on actually renovating that. But it returned a good value at that particular time. So the rental yield was particularly high, it was around about the 6-7%.
Yeah, that's incredible. London's such a different market to many markets in Australia. And look, we're not going to talk about the UK market because it's not really relevant to most investors here, but you could get potentially very strong rental yields in the UK market. There's obviously no negative gearing there. There's London's just phenomenal. It's, huge pressure in terms of the London market. So you were renting yourself at the time?
Yes.
Yeah. So
I've been a long-term tenant. only recently have I bought in Australia.
So when did you actually come back to Australia full-time?
I came back in 2009, beginning of 2009, I came back to Australia.
Okay. And did you still have the Roseville place in your portfolio by then, or did you intend to sell?
I still had that one. I had that one right up until the point of time when I actually purchased my own property to live in.
Yeah, okay.
So I was
it's tough.
Yeah, I know. I know. It was one of those decisions going, do I remove this income-producing asset to buy something that I'm going to live in myself?
There's a pressure. I had about 4, maybe 5 properties. I can't remember whether I'd sold one of them. I certainly had 4 properties, and I'd just bought a 4-bedder in Queensland, in Manly in Queensland, which I was very excited about. I bought it for a frighteningly low amount of money if I think about today's market. But with my long-suffering wife having been a tenant for many years, in Hong Kong, and also here, the pressure to buy our own place became too much, and I ended up selling off. I went down to 2 apartments to buy our own place. Now now I look back, I've rebuilt my property portfolio, but it is a big pressure. And at the end of the day, having your own bricks and mortar, it's not right for everybody, but it is certainly something where, you kind of look at having built this asset up and you think, well, why am I doing this? And part of the goal is to have your own place.
And exactly the reason I sold it. If I didn't have to, I wouldn't have sold it. But, the reason I went into actually purchasing that asset in the first place was to give me opportunity.
Yeah.
And that's exactly what it provided for me. I don't think if I hadn't had the asset, if I hadn't had the investment properties, I wouldn't have had that opportunity. I wouldn't have had the growth that it produced during that period of time.
Yeah.
And then I wouldn't have been able to roll that into actually deposit on my own particular property. So it did provide me that head start.
So where did you choose? What suburb did you choose to buy in for your own principal place of residence?
So I live in Seaforth now.
Okay.
Yeah.
Lovely.
I was probably lucky to get one of the only blocks of land in Seaforth that was been vacant for about 25 years.
So you built?
And built.
Wow.
Yeah. That was a long journey.
So how was that, just in terms of, let's just break this down. So you have an investment property, which I remember you had a very low LVR. You'd held this now for 6 years, 5-6 years?
No, longer. I had held that for about 8 years.
9 years. Yeah. Okay. So, and had you refinanced it?
No, I actually just kept the same lender the whole way through.
Okay.
In hindsight, I think I should have refinanced it.
Could have got lower, right?
Absolutely.
So you've secured a block in Seaforth.
Yep.
How big was the block?
546 square metres.
Okay, so decent size for that particular area. So how did you go about, did you just sell your investment property to use that to fund from the outset the build of the new place, or did you keep it and sell it further down the track? How did you kind of align the two transactions?
I sold it first. I didn't want to really commit myself into purchasing another property and then sort of having that bridge between the two of them. Knowing that I was going to service an empty block of land is quite hard.
Yeah. So did you buy the block of land outright and then borrow to pay the house? Did you have to borrow to buy the block of land and then?
I borrowed for both.
Yeah. Okay.
And this is where the investment property actually was good because it allowed me to then offset that capital into that.
Yeah. Look, I'd like to find out about what the process was from deciding to buy to actually moving in. But we'll talk about that in a couple of seconds. So we're just talking about the purchase that you made in Seaforth. So you've sold your investment property. You're ready to go with your block of land. What was from selling your property to buying the block of land, how long did you have to wait till you could actually walk in through the front door?
And that was quite a journey. It took 3 years.
3 years, wow.
3 years. When you actually look at planning permissions, and there's a lot that goes on in terms of just being able to put a house up on a block of land. So it was a 3-year journey before I finally got in there.
So was there a demo involved? Was there an existing old property on there? Or was it just a pure vacant block of land?
It was a vacant block of land. It was a flat block, or so I thought. No block is a flat. Unfortunately, there was a lot of excavation that had to occur, and I'm not sure how many people know Sydney, but there's a lot of rock in Sydney.
Yeah, there is indeed.
So that itself is quite an exercise in terms of excavating even a flat block.
So, and I assume that you were renting during the course. Were you in the area, or do you...
Yeah, correct. I was renting. I was actually renting close to here. I was renting up in Neutral Bay, so that was quite convenient to work as well.
So... You've obviously now got, an important part for you is to get your own bricks and mortar, and it is a fantastic location. But as an investor, what was the next step, and how did you plan to get back with having that big injection, with liquidating your investment asset, or certainly the one that was accessible to you? Yeah. How did you get back into investing after that?
Obviously, my capital was quite depleted at that stage, so I still maintained one other investment property at the time, which was a good income. But subsequent to that, I actually then moved out and we created our own business. So, in this space. So our investment journey had to be put on hold for a little bit of time as we poured a lot of money itself into the business. So the rest of the capital we had left over went into that, but we're actually now moving back into investment property again.
So, and look, I run my own business, and now, I mean, it's challenging for everybody right now in terms of going on to banks and getting finance. And I think, you look at the rates that are available and you go, wow, you can borrow for 3.2%. But the reality is it's actually very challenging to get finance over the line. And I know that although you've not worked in mortgage lending, you have worked for an investment bank in previous times. What are your thoughts in terms of the challenge to getting financing now, being a business owner?
Yeah, as being a business owner is very hard.
Yeah.
There's not just the assessment on ourselves and our own income, but it's, what's the profitability of the business? There's more analysis done almost on the business there, and there's us as an individual. So it becomes extremely difficult to actually then be able to go out to a lender and borrow to basically buy another investment property. Yeah,
the big focus for lenders now is very much on serviceability. And if you are self-employed, if you're a business owner, anything outside of PAYG, they're looking very, very closely at, at what your living costs are. And as well today, it's not a matter of what you declare. The lenders now have the opportunity to look beyond what you say you're spending and analyse very closely what you actually are spending. So it's very, very tough. So how long do you think it'll be before you're able to get back into the market?
We've actually recently started looking.
Okay.
So that's one thing. Interestingly enough, there's obviously a lot of different ways to invest. You mentioned it before. In the business I'm in, I get exposed to a lot of different ways of investing and different alternatives. And some of those have been quite interesting companies that I've actually started looking at that have allowed me not to be as reliant necessarily on mortgage lending, but can actually move into the property market still.
Okay.
So there's some interesting ones on the horizon.
There are, innovation is driving so many things these days. Bricks and mortar are still so attractive. I've recently purchased, made a bit of a sort of a kind of a snappish decision. So I've got myself and my business partner, Phil, share a portfolio, which is the Smart Property Investment Portfolio. We decided when we launched SPI that we wanted to show investors, warts and all, how we go about investing. So we built a property portfolio between us, which we publish every single aspect of that. That's worth about $7.2 to $7.4 million. I've also got a portfolio of my own. So I built up, as well as I bought a place in Turramurra, which cost me a couple of $1 million a couple of years ago. So what I really wanted to do was buy some investment properties separate to that, with a goal to paying down that mortgage eventually when I come to retire. But I got a bit of I'm 52 years old now. I've got a bit of a sudden urge to buy a little retirement flat. So if you're not familiar with Sydney, there's a suburb called Newport, which is on the northern beaches, just north of Mona Vale. So I actually sold my, I've got a place in Hobart, which did very well. I bought that about 3 years ago. I sold that, and I've bought an investment property in Newport. And you know what? It's been one of the hardest things I've ever done. Buying the property was great. I bought it for less than it was sold for about 3 years ago, because it's a great time to buy right now. When I came to getting finance, it was hard. It was really hard. I had to jump through so many hoops, and I sort of almost got it, sort of sorted out at the 11th hour. But now that's all done, I'm going to settle in about 4 weeks' time. It's really about, I'm looking to rent that out. So there's it should be a reasonable rental on that, but it's really a view to me to move into that at some stage or other with my wife, or at least have it as a kind of a weekender, maybe 3, 4, 5 years down the track. It's it's an interesting time. So what are you thinking about in terms of an asset moving forward for your next place?
Funny enough, location-wise is come into it, but this time actually looking outside of capital cities. Okay. So one of the things we are looking at is probably further afield, somewhere that I think also has good growth to it. I've actually looked at Queensland quite a few times. I've looked at Melbourne a little bit, but I think that's probably at this stage kind of where it is. I think it's not quite right. So to me, I think I'm looking more north at the moment. I think there's a lot of growth opportunities in the kind of the northern parts of Australia.
Do you have any kind of idea about sort of, are you looking for maybe a bigger block of land, or, what sort of, do you have anything, or are you just going to look for where there is an opportunity and where something catches your eye?
This one the opportunity's been a little bit more open.
Yeah.
So this one I've actually gone in with my eyes probably wider in terms of the scope I'm looking at. I still tend to have a tendency still to go back to lower maintenance types properties.
Yeah. Things
that can sort of be locked up and left if needed to, things that I know can appeal to sort of younger professionals or places that are in sort of commuter belt still. But I think there's a lot of opportunity, especially around the Brisbane market. Yeah, absolutely. And also, again, to your point earlier, places where there's some solid factors that are driving growth in terms of migration, and where places are, not dependent on any one particular industry. And that's right. I think industry across Australia is also changing in terms of the nature of the workforce and the types of service jobs that are actually entering Australia as well, and kind of releasing the economy from the old sort of mining economy and all that sort of stuff. There's a lot of innovation. I've recently looked actually at Adelaide, and there's quite a bit going on down there as well. I think that's another spot that is interesting too. Well, one of our other, Adelaide's a big centre for defence, and one of the other publications that we have, which is, we've got a defence title, we get a very big insight into the investment that's going into the defence industry, and Adelaide's got a lot of things happening down there. There's also a few innovation labs going on down there as well. And it's also as well, you mentioned mining, but we're increasingly in an economy, in a world where you're not required to go into work. So many jobs now can be done from home. So, it's quite liberating as long as you find the right areas. You don't necessarily have to be that 20-minute commute from the city. Absolutely. Mark, it has been a pleasure talking to you. Thanks so much for coming in. For everyone else, thanks for listening. Really appreciate your time. Look, we'd love to hear your stories. Please do get in touch. Whether you're a first-time investor, whether you've got a big portfolio, we're really keen to hear from you. You can reach us at editor@smartpropertyinvestment.com.au. I'm your host, Alex Whitlock. It's been great having you with us.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.